Hi, welcome to this tutorial on cryptocurrency and blockchain technology. Today we're going through Rule 2 of the 8 rules of cryptocurrency investing. Now, Rule 2 is about the fact that there is no easy way to make millions, which is a little bit sad, but you have to remember that before you get involved in a lot of cryptocurrency investing. Alright, so again, this is Rule 2 of 8 rules of cryptocurrency investing. The 8 rules are going to be a playlist or a series that I'm producing. We did Rule 1 last time, and now we're up to Rule number 2, and there'll be 6 more after this. Okay, so Rule 2, there's no easy way to make millions. Now, since this is about possible investments and financial decisions, I have to have this disclaimer. Please pause, have a read, it's very important. It's important that you understand that I'm not giving you personal advice in this video. I'm meant to be providing factual information for educational purposes, and I don't know your personal circumstances and financial goals. And in general, you shouldn't make investments simply because you see someone talk about it on the TV. There should be much more involved than simply that. Okay, Rule 2, there's no easy way to make millions. Now, the crypto markets have lots of promoters and advocates making lots and lots of claims. It's been one of the biggest news stories of the past year, but sadly, since January 2018, there's been a crash in the markets, and in reality, there's been lots and lots and lots of losses. People have lost their shirts, some of the horror stories have been really bad. So before you get involved in crypto investing and all types of investing, it's important to cover some of the realities of this space and what it involves. So today we're going to talk about 1, don't be a fool, don't risk more than you're prepared to lose, and be realistic. Then we'll move on to why realism in your investing won't stop you making possibly spectacular returns in crypto, so you can still be realistic but still have the good side as well. Thirdly, we'll discuss about how awareness of how young this investment space is and the risks of and rewards this implies when the crypto market is so new. And then finally, we'll talk about an alternative interpretation to the generalized negative statement about there being no easy way to make millions. Alright, first things we're going to cover. Don't be a fool. Don't risk too much money, and be realistic. In short, don't sell your house to buy the magic beans, the crypto beans. And crypto's kind of like the magic beans. No one knows what they're for, or well, not nobody, but a lot of people don't know what they're for. They apparently have some sort of value, but a lot of people can't explain why they have value. And often there could be a strange person telling you to buy it, similar to the guy that sold Jack his magic beans. Alright, so this idea is linked to the first rule. Now, in the first rule, we talked about knowing your risk profile and about balancing your risk and reward strategy and using appropriate portfolio allocation techniques. You shouldn't risk more than you're prepared to lose, and you shouldn't have all your eggs in one basket. You should have a well-diversified portfolio that could possibly include some crypto, not 100% in one cryptocurrency or something similar. Now, you should stay away from all leverage unless you're a professional or expert. And even then, it might not be the best idea. There's been many stories of so-called professionals and global firms blowing themselves up by using leverage that they couldn't manage. And then, again, as I've said, rule point 4, don't risk more than you're prepared to lose. This could all go badly. This market's very new, and we have to be careful. And there's upside, but there is a lot of downside in this market. Secondly, if it seems too good to be true, then it probably is too good to be true. This is about not being a fool. Now, don't fall for the big claims and promises. You see them on Facebook, you see them on YouTube, you see them in a lot of meetups and events. Everyone's trying to promise you something or claiming you'll something certain, and this is because there's a current lack of regulation that's putting few limits on what some people can promise. Now, where I'm in Australia, there are certain licenses and regulations in regards to financial investments that restrict what people can say or promise about those financial investments, or more accurately termed financial products in Australia. Now, you can't say certain things in Australia about financial products. You can't promise certain things, and you're exposed to litigation or sanction if you break those rules. Now, cryptocurrency is kind of in this grey area where there's not a lot of regulation, and that leaves a lot of room for people to promise far more than what they should be allowed to. I remember, I think it was late last year or early 2018, there were Facebook ads basically guaranteeing that this cryptocurrency investment would triple within like 2 weeks of putting your money in. Now that is just so out there, but the fact that they could get away with it speaks about the fact that people make claims and there aren't a lot of regulation in place to stop these claims being made. So you've got to be wary. If it seems too good to be true, then it probably is. And if you get involved in this space, you'll be surprised how regularly you're a target for like just blatant scammers, blatant pump and dump schemes, and advisors who don't disclose their conflicts, whether a holding in a certain currency or a relationship. Yeah, I try to be tech savvy. I'm only new to the Telegram app since I started crypto investing, and I'm still so surprised that people really think that they can just contact you and hit you up and try to milk information or scams out of you. Or I've got calls on my personal number offering to get involved in cryptocurrency investments, which too good to be true and probably just a scam. Now, as someone who owns a company, I've received these types of calls in the past, but since I've got involved in cryptocurrency investing, these approaches have been through the roof. So you'll be surprised until there's a real clampdown or a shakeout of these people in the market. Okay, yeah, I just mentioned people not disclosing their holdings. So while I'm not really a cryptocurrency expert, I'm still trying to learn as much as possible. Here are my disclosures. There we go. So if you ever hear me talking about these, you'll know where I'm coming from. All right, I do have skin in the game. All right, now this is the third point. We have to be realistic. For example, are you a better investor than Warren Buffett? Now, Warren Buffett has made an average of 21% per annum for a number of decades. That isn't 210% per annum or 21,000% per annum. People seem to be in this space like really upset if they don't double or triple their money in a couple of days or a couple of weeks, and it's staggeringly frightening that if that's the expectation of the participants in this market. Now, 21% per annum, not 2,100, not 21,000, not 210 or 2,100, but 21% has helped Warren Buffett make $90 billion. So that's not bad returns after all. You don't have to make double or triple your money in a couple of days. A steady 21% per annum, starting early enough, and you'll be you can make a lot of money. Warren Buffett's made $90 billion, and I don't think anyone will turn that down. Now, a mix of bonds have averaged 7 to 8% per annum. The S&P averages about 12% per annum, and you don't need to make 100 and 200% a year. Why? You have to ask yourselves, if bonds make 7 or 8%, and the S&P, which is a basket of stocks, makes about 12%, why would other investments be at such outliers? It's just not realistic. It's not realistic. I can't. I'll try to be happy about it, in that you can still make good, solid, safe returns anywhere between 5 and 21% per annum, in the case of Warren Buffett. So you don't have to double or triple your money, and if you think you're going to double or triple your money, then you may be in a rude shock. This is about expectations management. The people that get hurt the most in this market are the people that aren't aware of what the possibilities that could occur, who get shocked that they didn't double or triple their money, or get shocked that an investment can lose half its value. If you go in there with your eyes open, know what the realistic outcomes are, or the probabilities of those outcomes, then you're in a much better place when the outcomes eventually occur. Okay, just to stress the point, let's have an example. Can you make amazing returns with a boring investment that's just over the long term? And here's Exhibit A. Warren Buffett took over a textile company, Berkshire Hathaway, in 1965 for $19 a share. It's now 2018. What's the price of Berkshire Hathaway? And what would $1,000 invested in Berkshire Hathaway at $19 a share then be worth now? This is just a straight, dull, one stock, fuddy-duddy Warren Buffett investment. Let's see how we would go. Okay, so here's a stock chart of Berkshire Hathaway. Now, this doesn't go back to 1965 at $19 a share. It only goes back to about the start of 1980 when it was already $625 a share. So you've already done 30x times your investment by 1980, if I've done my sums correctly. But yeah, $19 to $625 by 1980, still an unbelievably good return if you hold on to it and do something very, very, very dull and boring and maybe not that exciting. But look what happens as time passes between 1980 and 2018. It's now $322,900. And that started at $19 and it's now $322,900. And that's right. That chart really does show that realistic, stable, methodical investments can really pay off. And so what would that $1,000 invested actually be worth today? Yes, there we go. $1,000 invested in Berkshire Hathaway in 1965 would be worth just under $17 million today. And I know 1965 to 2018 is a long time away, is a long time to wait for a return like that. But, if someone told me today, Axel, if you put $1,000 into this company and wait, 60 years, you can have $17 million. Do you want to do that? Guarantee I'd take it in a second. Any day of the week, I would take that choice. If I had to wait 65 years to make $17 million, absolutely on $1,000 down, I wouldn't turn that down in a heartbeat. And what's the moral here? Don't be greedy, irrational, impatient, and instead just make sound investments and give them time. You should be investing for a reason, not spinning a wheel hoping that the money will double in a couple of days. And here's our second part. Why realism won't stop you possibly making spectacular returns. So I've been kind of negative so far, talking about how things aren't going to work out and you being unrealistic and like have a bit of sense, mate. But many still have made great returns from ICOs, early mining of cryptocurrencies, and hodling, and also the general crypto bull runs. So we've got ICOs like Ethereum. I think if my research is correct, it ICO'd for 40 cents. And today's price was approximately $220. So that's about 55,000% return. That you have one investment like that in your lifetime, you'll be happy. Early mining or early hodling. Zcash, the price a few months after launch, so just the first miners were holding it, it was priced approximately $40. Now today's price is about $120, and that's a 300% return. So a 300% in 2 years, even after the 2018 crash, is very, very you should be very, very happy with that. And Zcash had a 2018 peak in January of approximately 775. So if you got out at the right time, it would be much higher than even the 300% return. Now, I did these slides about a week ago, so maybe a little bit longer. So if they're not exact, I apologize. And also, as just the general cryptocurrency bull runs, there's been ones in late 2013, mid 2016, mid 2015, all the way through to the new year of 2018. And there's even been periods since the crash in January of 2018 where you could have made serious returns just by trading the lows to the highs. And this is these markets, this is where all boats have been lifted by the tide. And I can just go to an example here. And here we have the coin market cap, total market capitalization. I'm going to show you some of these bull runs. So here's let's go to late 2013. So we'll go to, let's try 2014 to this 1st of February 2014. If I've done that correct. And here you can see there's a bottom of a market cap of what's that? Just under $1 trillion. Or no, just under $1 billion. I beg your pardon. So $1 billion, and in half a year, it's gone to $14 billion. So that bull run there in late 2013 and early 2014, basically could have made 14x your money. Let's go back out to where we were. Now, when you talk about the bull run from, where are we? Let's say 2015 to today. Oh no, we won't take it today. We'll take it to the peak of the market. So let's say January 3rd. Now, if you'd held for mind you, this is 3 years. 3 years you have to hold it for, from May of 15 to January of 18. Here we have a market cap of 3.8 billion, I think it is. Yes, 3.8 billion, all the way up to 641 billion. Like, that is astronomical bull runs there in terms of market cap and it was probably the major coins, but here 2017, there would have been some ICOs in there as well. But it's just staggering returns just from simply holding for a few years. And finally, I did mention that you can make decent returns since the crash. So let's take this back to January. So January of this year, 2018. Take it back to the 15th, so we post the crash. And here we have, perhaps in April, if you bought in April, 257 market cap. And if you've held it for 1 month, you've made about a 60% return, up to 453 billion in market cap. That's just one example. Here in early February, 362 market cap. 1 month later, you're looking at about a 20% return. And like, these numbers just like that are beyond comprehension for most people who've been investing for a while. That you just don't see returns like that. So there is still good news. So while I tell you to be realistic and I poo-poo things, there are still a lot of opportunities, and I don't want it to be all negative, okay? All right. Just remember that higher returns often mean higher risk or high effort and high skill. And just to be realistic about your returns and not greedy. Cryptocurrency is becoming more mainstream, so you may not see the type of wild volatility in returns in the past. Like, we were looking at those charts just then. As it becomes more mainstream, the volatility might taper out and they end up with those returns. I don't know. That's just often how some markets work as they develop. And it's important to have a longer and a realistic time horizon. For example, we've got the post.com crash. And that was probably the last time that a lot of investors got carried away about a new paradigm and a new technology that was going to take over the world. If you invested late in the dot-com bull run, perhaps in early 2000, you would have to have waited, I think, perhaps 8 or 10 years to see the NASDAQ back at its previous high. And that's again, if you're looking at 1 or 2 weeks or 2 months, waiting 8 or 10 years may seem longer than what you expect. But then again, if we have decent returns, I'm more than happy to wait 8 to 10 years for the returns that cryptocurrency has previously offered. But that's just my personal opinion. It's just about being realistic and not necessarily needing it in the next couple of weeks. Okay, secondly, we've got to be aware about how young this investment space is and the risks and returns that this implies. Now, Bitcoin, which is the major cryptocurrency, only launched in 2009. And there are risks when it's this new. What's that, 9 years? So we don't even know whether today's cryptocurrencies will fade away altogether and just effectively go to zero. Perhaps blockchain technology becomes something completely different to now, and the cryptocurrencies on offer today are just aren't worth at all what we think they are. Like, for instance, we may think we're investing in Google, but really we're investing in Netscape. So we thought Netscape in the dot-com boom was like the big tech that was going to be amazing, but it was really Google and their search engines who did something completely different to simply browser technology. And as for e-commerce, the big story in the dot-com boom was pets.com and about how that was going to revolutionize and be the epitome of an e-commerce future. But 10 years later, we realized that the future of internet commerce was companies like Facebook that weren't even envisaged during the dot-com boom. And Facebook and those sorts of firms are the ones that capitalized and monetized the internet revolution. Secondly, cryptocurrency could become hampered by tech and just die. We saw the bull run last year that the scalability and use of cryptocurrencies was seriously hampered. If it doesn't function as a currency or a medium of exchange or a useful asset, then possibly people will just move on. And there's always those stories about quantum computing, that quantum computing will be able to break the security of blockchain and the hash algorithm and the SHA-256 hash algorithms. So perhaps that occurs, perhaps blockchains evolve and fork and overcome that, but we just don't know. Simply no one can be certain in 2018 and at this young early stage of the technology in the market. So there are risks. Now, there are good sides to the same argument about it being such a new market. There are possible high returns to be made from getting in early. Now, up until quarter 2 of 2018, only about 25 million cryptocurrency wallets have been set up, and often many people have more than one wallet. So that would only work out to be, if each person had one wallet, about 0.5% of the global population. And stock ownership is about 50% of the US population, and direct stock ownership is about 36% in Australia. So what does this mean for the capacity of future demand for crypto? And as a kind of a comparison here, only 2% of Americans own stock before the famous 1929 crash. So before the 1929 crash, 2% of Americans own stock. Today, 50% do. And we're about to see where the markets have gone in that period. And at 2% of the Americans owning stock before the 1929 crash, it's actually closer representation of how many people perhaps have a crypto wallet now. So let's have a look what happened between 1929, when 2% of Americans owned stock, and what the Dow Jones looks like now, when approximately 50% of the US population owns stock. Okay, let's have a look. And here we are. So if you'll see down here, this is 1929. See that little blip there? That's 2% of Americans owning shares in the stock market. And we know what a huge bull run that was. And now look where we are now, where 50% of Americans and stock market holdings are considered mainstream and normal and generally safe investments. We go from a Dow Jones index value of 300 in 1929 at the peak to 26,500 in September 2018. You can do your own sums there to work out what sort of return that would be, but I'm trying to show you an example that there is upside if crypto does become mainstream and these types of investments become similar to something like stock, and what that means by getting in this early stage, similar to the early stock investors, and the returns possible if the future works out well for the cryptocurrency markets. So yes, while there are risks to getting in a very young investment space, there are possible returns. And it's important to remember that most new markets face difficulty. So stock ownership used to be thought as radical and risky. I've read books where they talk about all the normal investors only holding bonds. People didn't trust stock. They disliked the lack of security in a stock security. Investors didn't like the priority that stockholders had in company liquidations and so forth. There was a lack of access. You couldn't just jump on the internet like today and get involved in the stock market, you had to go to a specialist broker. Often you had to be from sadly, had to be from a certain group of people that had access to stockbrokers or a certain amount of money to get involved in the market. Not everyone could get involved, and there was less regulation. The SEC was only formed after the 1929 crash. Secondly, there was the emerging market debt market, and this used to only be a tiny sliver of debt markets. Government securities from emerging markets were seen as illiquid and volatile. They had poor historical data access. You didn't know what was going on. You couldn't find out what was going on. And there were also regulatory difficulties in emerging markets and cross borders. And both of those markets have gone on to be very, very healthy investment markets over time. But then again, there's also the tulip market bubble. That had a small participant base. There was a lack of asset utility, you couldn't really do much with a tulip, and there was a ton of irrational speculation. So you can see those reasons why those markets face difficulty, everything from lack of security, volatile markets, poor historical data, lack of asset utility, all kind of sound familiar with the cryptocurrency markets. But we just don't know, is this going to be like the stock market that changes, or is this going to be like the tulip market that dies a bad death? Okay, now we're up to our final section. The title of this video is There's No Easy Way to Make Millions. But what if there was a different way to look at that? What if you're an investor and you said, but there is a challenging way to make millions over the medium to long term by getting in early on the next disruptive digital space and its integration with Industry 4.0. Is that still an attractive prospect for you? Because maybe cryptocurrency investing might be for you then. Or if you're a trader, you may look at it like, instead of saying there's no easy way to make millions quickly, you could say, as a trader, do the inefficient, volatile and developing markets of crypto offer opportunities to gain a competitive advantage through asymmetric information by getting in early, and then all the masses of traders eventually jumping on down the track. So if you're a trader, can you see an advantage in being one of the first to the market if the market does grow? Just remember, at this point in time, it's like the Wild West of investing in the cryptocurrency space. So keep your wits about you. Be sensible until you get some experience, or until the markets develop and there is reliable regulation, reliable institutions, and reliable intermediaries to protect the retail investor. Okay, let's wrap up. What did we cover today? It's about not being a fool, not risking too much money, and being realistic. Be wary, be rational, be realistic. Don't risk more than you can afford to lose. It's about why realism in your cryptocurrency investments won't stop you from possibly making spectacular returns. And we talked about how ICOs, hodling, and trading bull runs can sometimes still allow very healthy returns. We talked about having awareness of how young this cryptocurrency space is, and the risks and returns that this implies, and that Bitcoin only launched in 2009, and there's been very little public interest until the last few years. And there's good points to that and bad points. And finally, we talked about alternative ways to look at the negative statement about there being no easy way to make millions quickly, because it may be possible to do it the hard way over the medium to long term. Okay, that's it. I hope it helped. Best of success. There are your congratulatory fireworks. Thanks very much. If you enjoyed the video, please subscribe to the channel. Click on the button that will soon appear. Get in touch. Feel free to comment below if you agree or disagree. I'll try to do my best to answer any questions. You can watch another one of my tutorials now. Just give me a thumbs up. And yeah, thank you very much for your time and have a great day.